The best part about real estate is the collaboration that is available. Partners, enemies, friends, foes, whatever it is, employees, employers. Listen, there are obviously groups out there that don't want you going out and doing deals on your own and stuff like that. But at the end of the day, you can't stop someone from doing that stuff. So the way we've looked at it and always have looked at it from day one is, let's be opportunistic with the right opportunities. It's as dumb as that may sound, but the collaboration behind it, whether we partner on a deal or not, or we look at a deal, and that's what I think is the best part about this business. It's not the money you can make, the upside, the tax benefit. That stuff's great. But the other side is you get to build great relationships and different partnerships. And if the deal doesn't work, you're not married to that person. It's one deal. That's it. And you could go on your merry way on the next one. So as long as you have that open dialogue and that communication, I don't think there's a better space for that openness, pending some other situations. But I love that component of it, of being flexible, that you're not tied down to, like you said, I got to hide this back because I don't want anyone to know it, right? At the end of the day, what we do, anyone can do this. It's not, we don't do anything different. We might do things a little different, but it's income and expenses, and it's management, and it's overseeing, and it's not reinventing the wheel.
Exactly. And that's how all businesses are valued, right? And plus, like, John, you could look at a deal and see this be the risk because it's an older product. Chris can look at it a different way. I can look at it a different way. So everyone has those risk profiles that, that's the beauty of it. I could look at it and say, like, this is a garbage deal. John could say it's a great deal, but like, it's just all these different perspectives. That's like the beauty of it. It's kind of like art, but in the end, it's backed by numbers and real estate.
Yeah, no, that point is key. I remember someone told me early on, value add, everything's a value add deal nowadays, but at the end of the day, my definition of value add is if I see something that nobody sees and I know I can deliver it, that's value add. Not taking a unit by doing a $5,000 upgrade and getting $100, right? Everybody sees that. There's nothing there, right? That is a value add. But when I look at a deal, if I see something that it could be that nobody's looking at, or if I know they're going to change the zoning so I know I can add more units, or if I know something that someone doesn't, that's the competitive advantage in real estate that you can share with people. But at the end of the day, if they're not as knowledgeable, that's your competitive advantage. And that's where, the value add component is. If you can see something that nobody does, or you see something and you can execute on it, that's where I look at a deal, you look at a deal, and Chris looks at a deal, and we all have three different numbers, right? It's not that it's not that we're looking at it saying something different, but my return threshold might be the highest, yours might be the lowest. Inevitably right there changes how we go about the deal, which is what makes it so special and so accommodating to so many different people.
Yeah, I was going to say real quick on that. I think that's too why private equity coming into our space in the Southeast has made it exponentially harder, because they have to make 4% and we don't, and we can't.
For sure.
Yeah. I know, one of the things that we talked about, in the last 12, 18 months before I, left, was looking at more loan assumption deals, because we were talking about, so many people were like, oh, why would I do a loan assumption when I can borrow money at 3%? But for us, it was, hey, we can buy something at probably a higher cap rate than what you would free and clear. So we'll take a little bit less cash flow, pay a little bit more interest on debt to have a better cost basis in the future. I mean, one of the favorite deals that we ever bought, slightly biased because I brought it to the table, but was, Park Landing. It was, we bought it for like a 6 cap in a 5 cap market. And I mean, I just think that deal's going to crush it. Is it the highest cash flowing deal in the world? No, not by any means, but it was a really good cost basis, quote unquote, recession proof deal, because it was a 70% LTV amortizing loan for the next 7 years. And, it's just in a really good submarket, in my opinion. So, I think those things are important too. Like, one thing that I may see as a pro, somebody else may see as a con, right? Like, I can fully understand why someone would be like, hey, I don't want to pay, if I can go get debt at 3%, why would I take on debt that's 4.5%? But for me, I think if you can find the right deal, there's opportunity there. So I think also too, everybody has certain reasons for getting into deals or looking at deals a certain way. They have outcomes and goals they're looking to accomplish, right? Like, when I came down and bought these 2 smaller deals, my goal was to be able to come in and refi out at least 70% of our money in 2 to 3 years. So the biggest difference being where if we had looked at a similar deal for Toro, we typically don't renovate 100% of the units because we want to sell it and leave meat on the bones for somebody else. But for me, I said, screw that. Let's renovate everything, maximize value, because that's going to get us the most debt post renovation and get us the most amount of money back. So it's like what your goals and outcomes are also going to drive how you look at deals and what deals you see as, valuable and worth your time too.
No, I think even to your point, I think we talked about it a little bit on Clubhouse last night,
Yeah.
but I think the syndication model, it's so hard because investors' expectations on returns hasn't really changed or gone down a little bit.
Mhm.
But you can't, if it's a 50 unit smaller deal that institutions aren't looking at, then attack it, right? And so it's I think just there's so much more media, podcasts, etc. on multifamily, then people are getting frustrated and going to mobile homes. So I think the biggest thing that you said was having an investing thesis of, hey, I know long term this is going to be great. Like you said, it doesn't cash flow perfect, but the appreciation on the back end is what makes this deal amazing. And I think just a lot of people are like, I need to make this percent, they're just very novice in it. And so it's just like, take the deal as a whole macro instead of like, it needs to hit this cash flow. Because after underwriting for pretty much 2 years, I've learned to underwrite less and just see if the story makes sense. And then obviously dive into the numbers, because like John alluded to, it's not a value add because John bought it and can charge $50 more in rent. It's, that extra piece that you can really derive value from.
And then you said something super key that people should listen to and hear out. And what I say all the time, if there's no story that's going on, or there's nothing, if it's just, a guy bought it 2 years ago and he's slipping out of it, that's the first question we ask almost every broker, wholesaler, anyone that brings us a deal is, what's going on here? Like, what's the story? And if it sounds like there's nothing there, I would say it's not for us, right? We want to hear something that we can easily pin value to. And the story is more important than the numbers, because I'll teach you a trick about underwriting. Take any broker book, take any pro forma, and look at the T12 and throw the 4 cap on it. That's probably what the broker is going to tell you the whisper price is, right? So there's nothing hiding there. Take the T12 and throw a 6 cap on, and that's probably your offer. That's just life, right? So there's all these crazy models out there, and that's what we use. But what's more important than all of that is what's going on, right? Where is there any pain points here? And that story is going to paint your picture before you even waste time putting it into an elaborate model, which we get asked, well, what model do you use? I'm like, it doesn't matter. Well, my model is a pen and paper that sits next to me because I know what they're going to want. I have to understand and dive into that story. And that story is going to tell you what's going on. And I think that more than anything is probably the biggest thing that we look for today is just, give me a story. Don't give me, I don't want the normal, he bought it 2 years ago, he hasn't done anything, the market's done great, and he wants a 4 cap now, right? Like I'm never going to buy that property because it's just not going to work for us.
And to your point, we're not saying don't underwrite stuff. We're saying we've underwrote so much that it's like, okay, it's like the Ray Dalio. You have the mental model of like, all right, I've seen this 100 times, so now I can apply this. So now here it is. So it's years of crafting that skill to see it. And especially with my background being a CPA, that's all I did was numbers. So it's just like, I can see on the income statement and fact check the story they're telling me was like finding the numbers. So I'm working with our analyst. He's like, hey, I'm like, remember our L10 where we had like the PMs had all this stuff and the plumbing issues in December? Well, here it is on the income statement. So it's just like crafting that, seeing the story and seeing the numbers and aligning the two up so it can be super helpful.